All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. We'll get started here in about 3 minutes. I'm on just a touch early here, but we'll go out and take a look at a few things here. Interesting day in the market. We're looking at a S&P down about 38 points. Down about 1%, right? A little more than 1%. And, coming down to, starting to get into a few retracement areas of this rally, this kind of snapback rally. It's now completely erased the post-election rally. Interesting looking at all the news headlines and everything else and kind of what's driving and what's out there. But, it's still pretty clear. We're not in a price stable type of environment at all. The fears on both sides continue to come and go very quickly, meaning the fear of I'm not in to the fear of, ooh, why am I in, right? Those fears, on both sides, they drive some of the up and some of the down. And, we're seeing that, we're seeing that in a pretty big way here. Big move in the dollar today. UUP up new high here today, up here to 26. Just continues to be a rocket ship here, and it's economically jarring for a lot of the emerging markets and whatnot. But interested to see some of the emerging markets today. While the dollar is hitting new highs, they're not hitting new lows. This is the first time we've seen that. Where, the emerging markets haven't hit new lows on a new high in the dollar. That'll play into a little bit of what we'll talk about here today with some divergences. But we do see that coming into play. And, we see a lot of stocks, just normal, type of price action. They've had a rally. Now they're kind of pushing back into retracement zones. Some of the companies that really had some negatives in terms of their earnings, in terms of future outlook, like Apple, getting hit a little harder. Of course, the J.P. Morgan price target drop here today doesn't give any confidence here with Apple, but this is still one that probably has path of least resistance a little bit lower. But overall, it's it's kind of the same old market. Same old market that it's been. It's not one that I think we're seeing any real spots changing today, where you can look at today and go, oh, well, the market's not materially different and it's going to be X. I think it's still that same environment that we've been talking about here over time. And, that still doesn't look like it's going away. Some of the V-shaped elements that, we talked about after the election, the risk and some of the risk factors that were coming in that could see a V-shaped recovery, those are being tempered, those are being kicked out. And, to see a little more down, maybe. This is probably one where if you're looking to call the bottom, if you're looking to say, you know what, I want to buy this dip. I want to buy this dip, and I want to be on the bottom. I want to make sure that I get in. You're going to be buying a bunch of times. But one of the things that you can look for that will oftentimes happen in these types of scenarios is we'll get a sizable gap down, and then some sort of rally on back, and we'll get kind of this, this rally candle that comes back into the prior day's action. Whether that happens tomorrow or the next day or whenever it happens. But those often are some pretty decent signs of a bounce, up and coming. If you go look at historic charts, that's often a nice little sign there. But, it's one where market always is doing different stuff. It's never, one cookie cutter thing that you're going to see, or, and if you see it, it's, perfect. But, that's kind of a tendency. When you get kind of this really nice rip after a correction, you dip, and then there's kind of just comes this gap down period where investors get a little frustrated, and that's when money starts to pour back in here with it. So anyway, it's one of those where with that, right, is gap down risk pretty high? Yeah, it is. It is fairly high. There's not a lot to drive this market right now. Earnings, economic data, no, no more wall of worry with elections. All we basically have are some of the, U.S. president and Democrats, exchanging a war of words. That's nothing different than what has been. So, we still see some of the European, Italian situation kind of getting worse, not better. And all eyes are on, what the next stage of the trade war, may be here. So, there's still a lot out there, but there's not a lot of data really to drive things, or things that the market can put behind them. Like with the elections, okay, market's able to put it behind them, great. That tends to be more bullish than bearish. Boom, it did it. All right, now doesn't have anything of that nature. And I do find it very interesting that the market pretty much has gone down since the Fed on Thursday. And, this is one where if you look at the timings, the whens and the hows of the drops in this market, so much of it is around the Fed, not on their, decision day or the day they raise rates or anything, but days where they come out and speak, days where they've really kind of made some pretty heavy statements. Market has been a net seller of the Fed, for a while now, and this is one of those where, the Fed just doesn't appear to be changing its spots at all. It's still, the market's looking at the data and going, wait a minute, data's starting to slow down, and wait, you're telling us something different. And, this is one of those areas where the market's reading the data differently than what the Fed reads the data. Is that all too uncommon? No. And in fact, there have been many times in the past where the market has read the data differently than the Fed. One of those is 2014, and the market, had to play catch up. The market had to rally to catch up to what the Fed had been preaching, right? But in 2007, in fact, I'll go back and show it to you. The market started seeing something that the Fed wasn't talking about. The Fed wasn't seeing, and the market went into some turmoil, and the Fed actually had to play catch up. The Fed had to change their tune. The Fed had to acknowledge that, things were going on out there in the market that they weren't, considering as high risks. And, this is kind of this July, August area here in the market where, the market just priced in something different than what the Fed was preaching. And so it created a big pullback. And, I can't help but wonder, with yes, all the trade war talk and all the election stuff and, all the Italian situation. We've seen all those things before. The S&P went and hit new highs, as all these trade war tariffs were being put on. We have seen debt issues in the Eurozone more times than we could count. It has just been a common theme across the region, since the inception of the Eurozone, whether it be Greece and Spain or Portugal, now it's Italy, and we've seen Italy before, even whether it's France or Germany. It's just something that has been pervasive, and, it's not necessarily a new issue. The whole Democrat-Republican issue, that is anything but new here in the U.S. There's always that going on. And, it's just one of those where I know those are the headlines, but, man, this just kind of feels like a market that is losing its confidence in the Fed. It's losing its confidence in the institution that has had a floor under this market for a long period of time. And really, I think what we are seeing overall in all of the summation of everything that has happened, as some of the data has changed, as some of the earnings have changed, as some of the Fed rhetoric has not changed, I think we're seeing one of these periods in time where the Fed and the market are looking at things differently, and who is ultimately going to win. We can go back and look at many periods of time where the market has been wrong and the Fed's been right. And we can see times where the Fed's been wrong and the markets have been right. And right now, they seem to be in very polar opposite corners, and neither is really giving. And that is something that poses a risk. And I think ultimately, if the markets continue to drop here, it'll be blamed on a lot of things that have nothing to do with the Fed. But I do think that ultimately, when you're a fund manager and you're looking at the markets and you're looking at some of the fears, your fears are not, oh, what do the Democrats say about the Republicans, or what does President Trump say about the Democrats? That's not your fear, right? Italian bond situation, that's not your fear, right? You're a fund manager. You've lived through that stuff a million times. You know what that looks like. That's not your fear. Trade war, yeah, maybe a little bit, okay, a little uncertainty there, but you've now been dealing with that for a long period of time. But the Fed element here, that is something that is dynamic, or that has changed dynamically, and is something that poses a significant risk going forward, and something that I think fund managers are really going to have to look at, to a degree that they haven't had to for quite a bit of time. Yes, there's always speculation about the Fed, and are they going to raise rates, and what are they going to do here, and what does this language mean? But in terms of just materially, the big picture, what's happening, it does look like we're seeing the markets diverge from the Fed, and the markets, instead of having confidence in the Fed, having this kind of Fed floor where, you can buy knowing that, hey, if things go bad, the Fed got your back. I think that's gone. I think that is gone. I think fund managers are starting to feel that. Oh, wait, that Fed floor that's been in here for years, that's gone. That's missing. So I have to account for a potential deeper drop, right? Where money managers for many years, they haven't had to account for more than a 10% drop. As they look at the market, as they look at how things are and what's going on, for a long time they haven't had to account for a big drop, especially after U.S. elections and whatnot. They just haven't had to. But I think right now we're in a position where the market's starting to have to at least account for that. I'm not saying we're going to have a monster-type drop, but it is one of those things that has to go into the back of the mind of investors, any these days, which, hasn't necessarily been a big fear of late. Back here, you could blame this on the VIX indexes and the XIV and some mechanical blow up that created the consternation back earlier this year. But even back here, the market still had some of that Fed floor. I think that Fed floor is gone, and I think that is something that the markets are going to have to wrangle with. And I think that's going to be a longer-term type of thing, and something that definitely increases downside risk out there in the markets for a while to come. For a while to come here. All right. Anyway, enough about the markets here and what's going on there. But let's go out and take a look at divergences. And talk about divergences with the MACD and the accumulation distribution line, and I want to talk about these because they're pertinent to what's happening here today in the market, this week, and what's going to be pertinent, here over the course of the next couple weeks. And let's go out and take a look at it. There's two indicators we're going to go and use, and I'm just going to use a daily chart. And I'm going to come in and put on a MACD. In fact, let's just clear everything out here. Let's just clean it all out. We'll come back in and we're going to put an indicator of the accumulation distribution line and the MACD. Now, we've talked about both these indicators in the past, so I'm not going to bore you going through the mechanics of these indicators here in depth, but I will give you a brief rundown, okay? The accumulation distribution indicator is an indicator based on volume. In fact, it was developed by a gentleman named Mark Chaikin. Still does some great work out there in the markets. Very analytical type of work out there, and it's kind of a very rudimentary form of his Chaikin money flow index. But it is something that I think it's easier to see divergences with, or to spot, some key changes with when they happen in the market. Basically, what it's doing is it's aggregating volume. And if you go look at something like an on-balance volume indicator, it'll take and add the volume. If it's an up day, it'll subtract the volume if it's a down day. So it, just kind of goes up and down with the market. There's a little different. There's a little formula in here that kind of takes gaps out of the equation. And it's looking for whether stocks are closing near their highs or near their lows. And something that is closing near its highs and has good volume is really going to be a bullish element. Something closing near its lows and has high volume is going to be more of a bearish element, right? And so it takes something like, like back here. Let's see if I can find. Let's come into. The market isn't the best spot to put this on. But we'll see much better examples than the market. But right here, right here, the S&P, it gaps up, it rallies. The S&P closes near its open price by the end of the day, nowhere near its highs. Is that really a bullish day, or is that a more of a bearish day, right? With the accumulation distribution, it actually is a little bit more bearish than bullish because it's closing near its lows on the day. And where a day like right here, where the market drops but it's way off of its lows, can actually, account for a more bullish type of day. Most times, especially with the market, the accumulation distribution line just moves along with the market. Right? It's subtle differences day by day and whatnot, but general market flow, okay, with the market. Now, with individual stocks, that's substantially different, and that's why we're going to apply it. But, this is putting in volume to the equation and looking at whether stocks are closing near their highs or near their lows, with the theory that stocks that close near their highs, even though they may not be up big, even though they may be down that day, that's more buying than selling. And even though stocks may not be going down in a material way, if they're closing near their lows day after day after day, that's much more selling pressure overall than buying pressure. And so it takes that concept and puts it into an indicator. And that's the basics of the accumulation distribution line. The MACD, this was developed by a gentleman named Gerald Appel back in the 60s. And this is a simple indicator in terms of how it's calculated. It's taking moving averages and taking a look at how they're moving, right? So the basic parameters on this are 12, 26, and 9, right? Well, if I come in here under overlays and I put two exponential moving averages in here, I put a 12 and a 26, we're going to see a pattern emerge. Okay? We're going to see a pattern emerge here. And let's click annotate. And let's get a vertical line. But right here, we have the 12-day moving average moving below the 26-day moving average. All right, this is what our MACD looks like. Okay. Right here, we have the same thing. Right here, we have our 12 and 26 crossing up. Notice where the black line is every time this happens. It's right at 0. A MACD at 0, which is our black line here, okay, MACD is the black line. MACD at 0 means the 12 and the 26-day moving average are at the same spot. That's all it means. And so the idea behind this is playing this kind of, hey, when a smaller moving average crosses above a larger moving average, that tends to be bullish. When a larger moving average crosses below a smaller moving average, or excuse me, a smaller moving average crosses below a larger moving average, that tends to be bearish. And that's all the MACD is looking at. Okay. Now, this red line here, all it is a smoothing mechanism. It's just a simple 9-day moving average of the MACD line. Many cases, you don't even really need it. Some traders like to use crossovers. When the MACD crosses above its 9-day moving average, that's bullish. Okay. Great. It's something where, yes, that's always nice to see. And yes, we can go back in hindsight and find plenty of situations where that happens. But we can also find whipsaws where, it was bearish, now it's bullish, and bearish, bullish, bullish, bearish. These crossovers, I don't subscribe to them all that much. The MACD histogram, this kind of bar that we see in here, this is just showing how far apart the MACD line is from its MACD signal line here, which is what they refer it to. But the idea is simple. When the black line is above 0, the momentum is positive. When the black line is below 0, the momentum is negative. And that's essentially what this is looking at. It's looking at momentum. And this is one of the first real momentum indicators ever developed out there for the markets. It has many variations on it. There are a lot of different things you can do with it. If you want to look for 3-7 crossovers, for example, you can put the 3 and the 7-day moving average on your chart, or you can just simply come into the MACD and you can come down here and say, all right, let's change the parameters, 3, 7, and we'll use 1. That way it's just the black line. And here we are. Here is the MACD for it. And you'll notice here's the 0 line, right? And that 0 is when the 3 and the 7 are together, and when it moves up above 0, they're crossing up, and when it moves down below 0, the 3 and the 7 are crossing down. Right? So, we don't have to put the 3 and the 7-day moving average on our chart. We can actually map the crossovers just simply using the MACD. Okay? And so a very interesting indicator in how it functions, but fairly simple in its design. Okay. Now I'm going to go back to the 1226. Okay, and I'm actually going to do 1226 and 1. I'm going to get rid of this red line from the MACD. I don't care about the 9-day moving average of the MACD. That doesn't tell me anything. That's kind of a pretty arbitrary line, in my opinion. One that helps investors feel good about a trigger, but doesn't really have any inherent value associated to it. Now, both of these indicators are kind of momentum indicators, aren't they? MACD, moving averages, momentum, the accumulation distribution. Okay, is the stock closing at highs or lows? We're talking about momentum. And anytime you're talking about momentum indicators, you can now start talking about divergence. And what is divergence? Divergence is when the indicator is doing something different than the price action of the stock. For one reason or another, the indicator is going one way, the price action is going another way. Divergences are often a sign that the price action has it wrong. That the price action in the short term is going to be reversed. So investors, traders like to look for divergences, myself included. I love finding a good divergence. Problem with divergence traders is if you're looking at daily, weekly charts, divergences take some time to set up. And you know what? They take some time to actually materialize. For instance, what do I mean? Well, let's go take a look at Micron today. Here's Micron, down almost $1.80. Micron's dropped, and overall, Micron is just slightly higher than it was at its lows. Okay? Well, the accumulation distribution line, that's made a much bigger move off of its lows. In fact, the accumulation distribution line is sitting where it was when the price of Micron was up here at 45 and 46. Is our indicator doing something different than Micron? Oh, you betcha. Now, this is November 9th. It's not taking into account today's price action. All right? It's not taking into account today's price action. So today's price action is going to take it lower because it's probably going to close, around here, or, it's probably not going to close at its highs. But if it does rally into the close, we could actually see the accumulation distribution line, move up a little bit. But what it does is it takes out the gap, right? Takes out the gap. Doesn't really account for the gap in a major way here. But here we have an indicator that's doing something different than the stock. Now, in technical analysis circles, there you hear the term price action is king, right? Nothing trumps price action. Price action is what it is, and it is the reality. And so when you're looking at divergences, it's not to look and say, ooh, that price action's bad, that price action's wrong. It's to say, look, this is the price action. But are we really seeing the intensity of sell? And are the odds of this reversing increasing? I mean, Micron's been setting lower lows, right? Lower low, lower low, lower low, lower low for months. The accumulation distribution line has been setting lower lows for months. It may still ultimately set a lower low. But what we have here is a stock that, or an indicator that is back up to a level that it was when the stock was at 45. Doing something a little bit different than the price action. So what do I do with it? For me, this is good enough to put on my watch list. This is good enough to say, okay, I'm willing to be a buyer. It doesn't mean I'm buying it today. It doesn't mean I step in right as soon as I see this divergence. How long has it taken this divergence to play out? Or to be created? It's taken several months, right? And so ultimately for this divergence to play out, it may take a few months. So if I go buy a short-term weekly option, is that going to help me? No, right? This doesn't apply. But when I'm looking and saying I want to establish more of a major position, let's just say I'm bullish on Micron, and I think Micron is incredibly undervalued here, which I don't. We've talked about Micron much. I'm willing to trade it. That's about it. But overall, when I see divergence come in to something like the accumulation distribution line, that starts to get me a little bit more interested in finding a good risk-reward entry point. Micron will be high on my list to be a buyer of when this next market leg or this current sell leg on the market is over. Why? Well, one reason is because of the divergence here in the accumulation distribution. It's showing that, yes, Micron has hit new lows, but in all, it's not the same magnitude of sell pressure that we have seen in the past. And so my expectations of a possible higher low increase. Now, let's go see if we see that with the MACD, right? Do we see that with the MACD? Well, take a look at the MACD. It's hit new lows, right? Every time the stock has hit new lows, the MACD has come into new lows, right? That's what we've seen happen. And every time Micron has bounced and had one of these bounces, the MACD has had a lower high. Lower highs, lower lows, right along with the stock. Yeah, the magnitudes may be slightly different. Who cares? I'm not going to read that much into it. Eventually we could stare into this thing so much that we're just, ooh, what does that mean? What does that mean? Not a whole lot, right? The indicator is moving with the stock. Lower highs, lower lows, right along with the stock. But this last bounce right here, when the market hit the bottom, the MACD, yes, was a little bit lower. A little bit lower. Had the MACD been a little bit higher, we'd be talking about positive divergence. But a little bit lower. But what do we see? The MACD bounce here has taken it to a higher level than where it was back here when the stock was at 45. Kind of similar thing to what we saw in the accumulation distribution line, right? So this is our first kind of sign since this whole Micron sell-off of some positive divergence, where the price action is, or the indicator is showing something a little bit different than the price action. The indicator is starting to show a little more sign of bullish life than what the overall price action may suggest. Now, that doesn't mean I go and buy it, but it does mean that now I can take it, apply it to my watch list, and look for an entry opportunity, right? Knowing I have this divergence behind me. I mean, it works on the downside. We talked about this in real time as it was happening, but back here on Micron, the MACD, new high right here. We talked about the big volume right here and the topping volume, and then it came and set a little bit of a new high, but MACD lower. Classic negative divergence. Stock hits a new high, indicator doesn't. It's generally a bearish sign. Let's just say Micron decides that the market is, too ugly out there. Micron sells off and goes down here to 32. Sets a new low. But yet the MACD just comes down here to -2 and actually sets a new high, or sets a higher low. Lower low on the stock, higher low on the MACD. Generally, what's that a recipe for? A nice little snapback in the stock. Now, that hasn't happened yet. I'm not saying that's going to happen, but that would be kind of the scenario for that to happen. Okay. Take a look at Nike. Any divergence in the accumulation distribution line? Anything to read in? Is it doing something different than the stock? Nope, not at all. Not at all. So it just doesn't mean anything to me. What about the MACD? Is it doing anything different than the stock? Nope. Up and down, right with the stock. We get a deeper low. Oh, a deeper low on the MACD. We get a snapback in the stock. Oh, the MACD snaps back. Okay. It's trading right along with the stock. So I show you this because, look, there's nothing to read from this. The indicator is moving with the stock. And if the indicator is going to move with the stock, I'm not going to read anything into it. Right? I might as well just look at the stock price and try to make a determination. I don't have anything really different happening. And so when we get in a market environment like this where things are moving at a much bigger pace than what they have for years, when you start to see some of these divergences, they can be some really nice signs of some things to come as things go forward, right? Take a look at U.S. Steel. Here's U.S. Steel, accumulation distribution line, lower, lower, lower. But take a look right here. Accumulation distribution line hit a higher high, while the stock did not hit a higher high. that's one of kind of your first little signals of possible divergence. Now, I'm not going to just say, oh, well, because it hit a higher high and the stock didn't, I can just go buy the stock whenever. No, I want to see the stock hit a new low and the divergence hold, right? We could see the higher high come in. I mean, here's U.S. Steel right back here, and the higher high comes into the accumulation distribution line. Didn't mean a hill of beans ultimately, right? When we see the lower low come in. So we don't have divergence. But a higher high is your first kind of sign maybe some divergence might be coming in. Let's come into the MACD. U.S. Steel hit a new low right here. Okay. Great. It happens. It's another low. Where's the MACD? It's a higher low. That is classic positive divergence. Classic positive divergence. I look at this pullback on U.S. Steel and I go, okay. I'm looking at a stock that has had some awesome positive divergence associated to it. So this is something I'm going to want to trade to the upside. It had a nice thrust here. It's now pulling on back with the market. All right. Where are my retracement levels? Okay, do I have a good risk-reward scenario? Now I can start applying. I haven't found an entry yet, but ultimately, is one going to come in that's probably going to have a real nice move to the upside? That's what the positive divergence suggests is a higher possibility. Look, we had positive divergence right back here. MACD low, or a stock on a lower low, MACD on a higher low, right? And we got some nice upside, to it. Wasn't monster upside, but some decent upside to it. Then the stock pulls on back, and you go, oh, okay, MACD higher. Well, yeah, so's the stock price. But right now, we have some very interesting positive divergence going on with U.S. Steel. If we come into something like an FCX, right? Accumulation distribution line, anything here? Nothing. Not a thing. It's just moving with the stock. What about the MACD? New low right here? New low in the MACD. Okay. This rally, MACD rallied, but it was lower than where it was back here. There's no divergence here. It's just moving right along with the stock. So I moved right along. I'm not going to use this to try to ascertain any type of read, any type of understanding of the stock. Here's General Dynamics. Take a look at the accumulation distribution drop here. And then the stock pops, and take a look at the pop here on the accumulation distribution. Pretty puny there in terms of that. Does MACD give us anything? Nope. It's just kind of moving right along with the stock. So I don't get any kind of divergence. I want to be involved in General Dynamics. I'd love to trade General Dynamics, but there's nothing really here for me from a divergence standpoint. Okay, and this is something that if you go through the stocks on your watch list, and you circle those that have some of this divergence associated to them, it can be a powerful tool to understand, okay, which stocks are going to, maybe do a little bit better going forward. Which stocks, maybe, may not do as well, going forward. Here in the last challenge, we traded Caterpillar, right? This is a stock that the MACD had been rising as the stock had been flat for 2 months. Had that nice positive divergence element come into it. And so got a chance to play it, and I took it and played it, right? But it was one that showed up on my watch list, was circled on my watch list to look for an opportunity to buy because of the positive divergence in the MACD. Okay, and that is something that we don't see in Caterpillar right now, right? It's not like that's what we're seeing or that's the case here for it. In fact, not even close. Triple M, which it had some nice positive divergences associated to it. Really nothing there. Nothing really there right now. So, nothing that I'm going to read too much into with, when it comes to, Triple M. But stocks like U.S. Steel, stocks like Micron, there are many out there that apply. Now, for the upcoming challenge, this is all well and good. You're going to see I'm not really going to use the accumulation distribution line. Because when you apply the accumulation distribution line to a 1 hour chart, you lose all interpretive ability. Why? Because basically you have morning gaps, and the highest volumes in the morning and in the first hour and the last hour. So it's just there's too much skew to it. So I don't really care. Just forget it. I don't want anything to do with the accumulation distribution line. But the MACD, oh, you betcha. Take a look at Triple M. Low, 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 low. Wait, MACD, same level. Stock price down, 10%? That's some nice positive divergence. Some very nice positive divergence. We will see a lot of stocks, setting up for this, where they don't have it on the daily chart, but they do have it on the hourly chart, coming into play. Here's Caterpillar, right? Do we have any type of positive divergence? Nope, none. It's just not one that has it right now. But there are plenty out there that are starting to show that they very well could. Right, some of my favorite stocks don't. For example, a Nike right here, it's just moving right along with the stock. But Nike right back here, lower low, higher low on the MACD. MACD moving up while the stock's moving on down. Right here, we have the MACD dropping while the stock's kind of flat to slightly dropping. Now, that's not divergence. That's moving right along there with the stock. But when we see, a little bit of a bottom come into the market overall, we're going to see some of these divergences really setting up. And they're not going to be in things like, probably not going to be in things like an Apple. But take a look. Here we are with this low right here. MACD low. Stock's at a new low. Today, stock is hit a new low. MACD is not hitting a new low. If we start to see Apple move higher from here, what do we have? Positive divergence. Positive divergence, right? So if it holds right here, if it doesn't push any lower, we have positive divergence on the hourly chart to go with, a stock hitting a new short-term low and a stock that, is sitting pretty close to the 200-day moving average. So kind of interesting. But you'll see me in this upcoming challenge using some of these hourly divergences, to get into. It's not like the divergence is going to say, "Hey, Jeff, go get into this. It has divergence." It'll be, "Oh, wait, we have some divergence coming here. All right, now we're moving above key moving averages. Now we have some crossovers. All right, let's go and let's take it and let's run with it." And we'll get them on both sides. We'll get them on the upside. We'll get them on the downside. As they come in, with this market. One that I'm very interested to see is Visa. Right, and here's Visa. And if we come into the hourly chart and we look at the MACD. Sorry, let me pull it up here. All right, my eyes must, there it is. We look at this MACD. You can see this low right here. Stock hit a new low at the end of October. But we had some positive divergence come in, right? Some real nice positive divergence here. The stock's not going to hit a new low, in terms of, and be able to hold this divergence. It could hit a new low, but we're not going to get another round of divergence. We may get a higher MACD, but the low of Visa will probably be higher. But after this positive divergence here, we've now had upside confirmation with the MACD hitting new highs as the stock has hit new short-term highs. So we have a very positive picture from a divergence standpoint, and then from a, hey, not giving a negative divergence standpoint. So now, okay, yep, MACD is moving with the stock, but this is something where we start to see it uptick again. It's going to likely have a really nice signal associated to it, and one that I want to be involved in, and one that I want to be buying. So, when I look at it from a challenge standpoint, I'm not looking for this exact day of oh boom, it sets the divergence and I'm going to catch this low. No, probably not. Right now, with the gap, everything fine maybe, but overall, I'm looking for healthy divergent pictures that allow me to get into stocks that are going to, likely outperform, and vice versa. On the downside, looking for some negative divergences, to potentially come in. Here's Exxon. Exxon MACD hit a high right here, right, and then the stock hit a new high. A couple days later, did the MACD? No. In fact, the MACD hit a new, or did not confirm this new high. We have a negative divergence picture here, right? We have an absolute negative divergence picture, which is switched from what was a positive divergence picture. Notice this low right here. Then we get the lower low with the MACD with a higher low. So we have positive divergence right here, PD, right? Positive divergence, and now we have negative divergence, right? Coming into the hourly, and they can switch like this, but those are this is going to be something that you'll hear me and see me talk about a lot in the upcoming challenge and with stocks, and we're seeing these come in to such a greater degree right now, than we have. I mean, back in 2009 to 2014, these were commonplace. But when the market stopped moving, when we just started to see things go flat, a lot of divergences, and yes, markets went up over time, but the pace of movement was generally so slow. A lot of divergences didn't really set up. Basically, you just had stocks kind of, go and they make a move, and then they go flat. Then they make another move, and then they go flat, another move, and then flat. And, there weren't any divergences. It just, okay, as they went through the flat stages, the indicators went back to zero. That's all that was really happening. So we see an increase of these divergences out there in the market today, these divergences setting up, and I suspect that it's not going away anytime soon in terms of these divergences. But that's divergences with the accumulation distribution. More for daily charts, more for daily, even weekly charts. Nice little application there on accumulation distribution. MACD, much more for daily, sure, but hourly, even 15-minute charts, shorter term charts. A nice application there with the MACD divergence. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.